So, as per the introduction, we're here to talk to you about the secrets of effective transaction monitoring. Not going to promise to solve all your problems, but we're going to give you some interesting insights. I think with a great panel we have here today, I should just mention the obvious that some of the things that may be mentioned here are personal views and not necessarily the views of the organizations that we are representing or work for. So, and I should mention, by the way, I'm not French. The scarf is because of my neck, so you can ignore that. So you had an introduction for me, and then I'll pass on to Manuel next to tell you a bit about himself before we move to a conversation.
Thanks a lot, Vangelis. My name is Manuel Lackus. I'm with Credit Suisse, based in Zurich, actually, in Credit Suisse headquarters, but I am holding a global role as the head of transaction monitoring IT within the Financial Crime Compliance Technology Department. That role encompasses, obviously, very clearly the maintenance and the strategic build-out of our detection systems, but also the broader ecosystem around transaction monitoring, being it our data platform, our data strategy, our next-generation tooling, as well as our investigatory tool sets that we are using in order to leverage and help our investigators to make their lives easier and fight financial crime effectively.
Thank you. Very good end-to-end insights here. And over to you.
Yeah, sure. So my name is Muken Ladva. I work for NICE Actimize. I've been with the company for about 8 years. I lead the strategy for the AML line of business for the EMEA region. So in terms of where the product needs to go, I look after that. I speak regularly with not only regulators but FIUs, but obviously with prospects and clients. We've got an extensive customer base, so we have many conversations, which is always very useful. I won't say we ever do everything 100% correct. It's always a learning exercise for me. Every day is a school day. So for me, thank you. Hopefully you guys get some good insights into where I see the industry going from a transaction monitoring perspective, but hopefully it'll be a nice debate for everyone to hear.
Right. Great. So, yeah, we've got some very good people here to discuss the topic, and I think we'll start by, laying out the problem and say, looking at, what are the biggest hurdles that we're currently facing in terms of transaction monitoring. I think, we'll all agree it's probably a big topic of discussion, much more so than, many of the other financial crime controls that we have in place. So why is that, do you think, Manuel?
Well, I could obviously now start with, the ever-increasing regulatory pressure, etc., etc. But honestly speaking, I think most of you have heard about that already for the last 5, 6, 10 years, and obviously we've heard about it in the previous panel in depth as well. So from a transaction monitoring perspective, there are current themes that we need to take into account. Predominantly, in my view, right at the moment, a rapid shift in customer risk that needs to be taken into account. It is obviously the basis for your transaction monitoring system on the one hand. On the other hand, we see, due to the market volatility, quite a shift in transactional behavior for our clients. So we need to ask ourselves, is our segmentation still in place? Do we need to recalibrate our systems? Recalibrate the systems on an ongoing basis obviously takes into account costs, takes into account resources, right, and takes away the focus on strategic thinking. But honestly speaking, those are current market events. From a broader perspective, I think there are 3 major themes that are not current, that have been there 5 years ago, 10 years ago, and that are going to be there 5 and 10 years ago. And that is obviously, A, how can we find the true positives? And how can we effectively and truly find the true positives? B, how can we do that without overwhelming ourselves with the false positives and flooding ourselves? And then C, how can we do that in an operationally effective manner? And I think the holy grail there that all of us also heard already for many years, right, and are going to hear for another couple of years, is analytics in all of its depth and breadth. Up to AI, ML-based solutions. We've heard about that earlier today already. But if I may tackle the 3 things separately, I think first and foremost, most of the organizations today are already on their journey. It's not at all anymore about getting started. I think most do actually try to bring their wheels on the ground. It's more around how can we, steered it clearly and not drifting too far right or too far left. So the first one is clearly, how do we pivot away from purely rule-based models in order to find actually more meaningful alerts while still staying at that comfort of our rule-based baseline, and without, and that's then the second topic already, staying on our rule-based models on the one hand, while then creating additional false positives secondly. I think here the answer is, and I may quote here actually our global head of surveillance, you need to have a fully traceable risk assessment. You need to know what you want to find, and you need to know what you want to find in each and every region with regards to that. And then secondly...
And isn't that, if I jump in there, part of, some of the issues with what we're trying to do, sometimes probably people think technology is going to solve their problem, right? Rather than, knowing, first of all, what's our risk before we ask technology to solve that problem.
I fully agree. And I mean, knowing our risk has various different dimensions, right? And it's an ever-evolving process because our risks are also changing very clearly. I think we need to understand, and I actually heard that earlier on another panel and fully agree, we need to sit together as technologists with our analysts, with our senior SME surveillance specialists to see where do they actually find interesting cases. And in most of that cases, we actually see that a single rule-based model did trigger that, but way more is coming on top of it until it's actually leading into a SAR. So the other question is, how can we mimic that behavior of the investigator and bake that more and more into our system? I mean, I don't have the magic wand for that, right, in the answer, but that's clearly one of the key questions.
Right. Yeah. But as you said, this is an ongoing thing. It's not something you do, and you can say you're done.
Yeah, I wouldn't mind adding on that. So, when I'm speaking with heads of compliance, with MLROs, etc., the business essentially, there's two areas that they're looking to address, right? Which is efficiency, reducing costs. We call it efficiency. And secondly is coverage, making sure that we're covering all the risks. So it starts off, I think you mentioned, it starts off with a very good risk assessment, right? So if you got that wrong, you're going to get everything wrong afterwards, right? So it's extremely important having that first risk assessment and understanding what your customer base is, what your products are, and where the risk lies. Once you've got that, then if you put it into let's say the process of transaction monitoring, right, which is, right, there's a data feed, right? So there are definitely technologies out there that can add to that data feed. There's companies out there that specialize in providing specific data, UBO information, shareholder information, related party information, et cetera, et cetera. There's a vast array of information available. Secondly is, once we've got that data, how do we make that useful from a detection perspective, right? So being able to use that from a rules, I absolutely, if you guys know NICE Actimize, we've been around for a long time. We are a rules-based solution. That doesn't mean we won't augment that with machine learning capabilities. We absolutely will, and we do. We definitely think that's the way forward. But FATF have various red flags that we want to address with our out-the-box rules, right? So we're going to address those. That's the cover-all kind of. It's a net, right? Then we augment that with various machine learning capabilities, and we can talk about that in a bit more detail later. But that's the detection. After that, you've got investigation. So let's see efficiencies in the investigation. I've seen various banks around the world, increase the number of analysts that they've got investigating their backloads, their ongoing alerts, 3- to 4-fold. It's extremely expensive, right? So if we can do anything to address that from a technology perspective, I think that definitely helps with the efficiency cost side. But ultimately, if we can get the accuracy of the alerts in the first place, then we'll be producing fewer false positives. The issue is false positives, obviously, and that comes to my fourth point, which is a good optimization capability. If off the back of how you're dispositioning your alerts, if you're able to feed that back into, let's say, the detection engine, and get the detection engine to learn how you closed it, why you closed it, what scenarios was it that you closed that alert behind, right? Then it will be a forever improving model.
So where we're not doing that very well, Manuel. I think you had a couple of other things you wanted to mention there.
No, it's actually
we seem to know the problem, but yeah.
No, it's actually intersecting quite nicely. Look, I think that's actually the pivotal decision that an organization needs to take, not to add on top of your net, on top of your baseline, as you very nicely called it, additional detections, because that is just increasing your number of, well, not false positives, but overarchingly your alert volume, right? And that is going to overwhelm your investigators at the end of the day. I think once you have established and are feeling comfortable with the number of rules that you're having in place, you need to tackle them one by one and see what can you do better, right? And what can you replace with the other? Because it doesn't make sense to keep your rules running and then have on top of that additional, very special, very customized, detection capabilities, and you're just creating not necessarily more noise, but just more in general. And I think that's one of the roots that some institutions overall, right, or the industry is probably really need to be clear on, that when you go onto that journey and when you want to be more holistic in terms of your monitoring, at the same time you need to also think about what are my current, I don't want to call them legacy, right, but baseline controls in place that I then need to switch off in order to find the right balance.
Mm-hmm. And do you feel there's an element here in also, you mentioned a cost, obviously. I mean, do you think we actually know how much we're spending to manage these processes?
I hope we do. Yeah, I certainly hope we do. Yeah, I mean, just by looking at numbers of analysts, it's in plain sight in terms of the increase in cost in terms of investigating the number of alerts that are being generated. So I think it needs to go back to bare basics and to actually let's look at getting a better accuracy of alerts, so reducing the number of false positives. I mean, that's the goal is that everyone's trying to achieve, right?
I fully agree, though we just, and it's actually very recent, had a very interesting discussion with our global head of AML, actually, who said a false positive is per se nothing actually bad, right? It's just a client that you have reviewed, it's a behavior that you have reviewed. The question is, what are you going to do with it, actually? Are you going to use that intelligence, as you said earlier, in order to prevent going forward false positives being triggered? But it's still, at the end of the day, a risk that you have addressed. You just need to make sure that you are not, blindly ignoring that and have the same customer alerted, 2 weeks later, and again look into the customer front to back. That's actually where the inefficiencies are, in my view, really then piling up.
Okay, and where is the balance then? I mean, we talked about obviously the technology, but what's the level of where do we balance the technology with the human element that you mentioned earlier on, Manuel? What level of integration do we need, and where is the technology going to help manage not just the technical aspect? You mentioned analytics as well. How can we move away from, again, expecting that the technology is going to give us a magical answer to having an integrating end-to-end solution in terms of being able to understand our risk and then have something that makes sense in terms of the monitoring?
I mean, the starting point, and repeating myself there, right, is obviously a risk assessment. You need to know what you want to find. There is obviously a margin that you don't know that you want to find, but the majority you are aware of through your different processes, right? Investigations, manual investigations, et cetera, et cetera. But I think we also need to focus on, and that's then the end point of that discussion, what can an automated transaction monitoring system provide you and what can't? Because no automated transaction monitoring system will ever find all true positives. So the question is, how do you balance that? How do you keep your transaction monitoring system on the one side efficient with the greatest coverage that such a system can have? And then on the other side, how do you address your other risks? And I mean, there, one idea can be that you're setting up actually a small group of very industry-savvy data scientists, right, who are looking manually through your data in order to find those outliers that your system, just by design, will never be able to capture. Which then brings us, you mentioned it earlier, to the point. First and foremost, you need to have their standardized data set. You need to have the tooling on top of that, et cetera, et cetera. Yes. But I think that the key takeaway for me there would be know what your system is supposed to do, but also be aware where your system is going to reach a limitation at a certain point.
I guess that is, expecting your transaction monitoring to basically do all of that. What you described doesn't indicate that, there's a clear understanding of the risk or actually the role of that control, right? That's not what transaction monitoring is about. So, it's you need to have the right expectations. What are you going to get from your system? It's not going to answer your questions. The points you mentioned is more about advanced analytics and make sure the controls are, within a framework that allows to monitor all your risks across the controls you need to have in place. But I mean, I definitely would say that, you find that in the battle of trying to manage false positives, people think that, transaction monitoring should be doing something almost magical in terms of, not having anything that, you shouldn't be reviewing or, have to do some work on that may seem like it's a waste. Anything else from your side on this?
Yeah, I mean, sorry, if Manuel mentioned, right near the beginning, just understanding your customer base, segmenting that customer base, that's actually key early activity, right? Ongoing as circumstances change, you might have to reassess your segmentation base. How would that be done? I mean, it's a complex scenario, right? You might need a field of data scientists undertaking that piece of work. Now, if there's some models out there, machine learning models that are able to actually use the data that's available and suggest to you, given your business segments that you're recommending, and provide let's say a finer detail of those business segments, maybe not 10, 15 business segments that you normally have, but maybe 75 clusters of micro clusters of segments, then that might give you a better profile to understand, are you actually behaving unusual compared to your peers? If you're having a £5,000 transaction compared to your peers, is that normal behaviour? It might be, right? Dependent on what segment you're in. So I think reviewing your segments is key. I don't think it's something that happens continuously, but it's something that should happen, let's say, often. So because people's lifestyles change, you come out of university, and then you progress in your career. Your salaries change. You might move country, etc., etc. So there's definitely, tools that exist that help in that modelling of the segments to start with, and then it continues in the evolution of.
Absolutely. I mean, you need to keep on top of that, and I think somebody the previous panel talked about the CRA and making sure the CRA is correct. Basically, you need to understand your customer, where the risk is, right? And that's never stops. So segmentation is very important. And, I didn't say that, thankfully, everybody knows how to put their questions through because I didn't mention that. But so I think we've got a couple of interesting questions. I'll bring them in now here because, basically, how do we actually manage that need of managing, the false positives and the operational side versus what we need to be doing? Manuel, you said about the changing risks all the time that we're all dealing with. We probably all have some big program to address TM. I mean, how do you manage that? Where do you manage the priorities? Where do you put first in terms of saying, right, I need to maybe reduce my false positives because, I'm being hit by the cost in my operation versus, I need to build, some new tools, move to AI or whatever else, might be happening.
Well, I mean, ideally you wouldn't need to balance that out, right? Because your program entails all of that, but that's obviously the nice and shiny answer to that. I mean, in reality, I think first and foremost, financial institutions do have the necessity to have the coverage in place that they need to have in place. And if that comes at the cost of additional alerts, being it false positives or, just triggers stating that more generally, that is what it is in order to maintain that regulatory coverage. I think what is then, though, important is not to, at that point, move away and just accept that. But once you are at that point, look into, if you now find after 1 year, after half a year, that your number of false positives remains as high as it is, what is the reason for that? One reason could be that the thresholds have been setting wrongly because of the market circumstances have been changing. But I think what we find predominantly across the industry is that the data is actually one of the key problems, right? That segmentations have not been applied. that certain transaction types are being included, that there is a heterogeneous setup of data across different locations, which makes it difficult to compare, et cetera, et cetera. And I think that element you can, to a certain degree, only do retrospectively, because there you need to get the insights actually from the analysts in terms of why they believe that is a false positive, in order then to act on that.
So, as the person, you know, in your current role, sitting there as a responsible for the technology, this will sound like a job interview, and you've got the task to reduce the, the false positives, but then you also have to implement, a new AI tool, within the same year. How do you manage that if it's conflicting in terms of, where your priorities are and what you're being asked to do? You've got, two different sets of people maybe shouting that they are, but the priority, and where do you, from your point of view of the technology side, or also from the vendor side, how do you manage that?
Well, the question is, what is the baseline, right, that you can work with, and from that baseline on, then what are the, that sounds oversimplified, right? But what are the priorities? I don't think we have the luxury to just focus on one of the two, as harsh as it sounds, because obviously, on the one hand, you want to reduce false positives on an ongoing basis, or at least increase the operational effectiveness around that. On the other hand, you have an AI, ML-based model that you want to implement in order to have additional detection. But I actually believe the one doesn't go without the other, right? Because if you know where your true positives are lying, which you can then find with an AI, ML-based model, that can help you also in the calibration of your current system and your current state. So probably the question is less around what do you do, but more how do you slice and dice it with regards to your different regions. If you are, as Credit Suisse, right, as Santander is a large organization, start probably more on a location-by-location basis and then move forward with regards to that. But I actually believe that only looking into the one side of the equation is not going to help, right? Because you need to take both into account, because it's almost symbiotic.
No, absolutely, I agree. I mean, at the end of the day, we were saying earlier about the risk. You need to address the risk coverage conversation and gap, or whatever it is that is going on in the organization. So you need to prioritize that. But that's I think that's what it's usually very difficult to do that because we don't necessarily understand the risk at any one point in time. How does this affect what do you do usually with us?
So I'm going to take it even further. Right, there's machine learning has been around for a while now. I think a new area that a lot of vendors or the industry is looking at the moment is around network analytics, is using new technologies such as GraphDB, etc., and trying to understand who is the customer's customer. And if you're looking at a corporate, it gets extremely complicated, right? A corporate can have many shell companies, subsidiaries, etc. And then if you're lucky, you might actually find the UBO who's actually connected to a terrorist finance organization somewhere, right? Which you wouldn't have found if you didn't have that network analytics. So my view is that start with the rules that will give you that base coverage. Use machine learning where it makes sense. Don't go full in. Day one, build it, use it, trying to get some benefits. Start with the business benefits. Try to understand what you're looking to achieve. Then build your machine learning models in, and then use what other capabilities. And that's network analytics. So if you're looking at correspondent banking, or if you're looking at corporate banking, it can be extremely complicated. And if you pull all of that data within a case management system, you're just going to see a spider diagram. Yep, it's not going to make any sense to you, an analyst, right? It's going to be extremely complicated. You're not going to know anything. So if using that GraphDB technology, etc., that you're able to wipe out all of the noise and just be able to show that flow of funds across the various nodes you've got, then I think you're going a long way in terms of being able to show the actual crime that's been committed, but also being able to show to the analyst exactly who's involved in that at various stages. So I think that's where I think we're going as an industry.
Right, and it's interesting, Muken, that you mentioned network analysts, so there's a lot of questions coming in, so thank you, guys. So, because we said we need to give them the secrets, I think I'll try to address them rather than talking generically. So, to that point, and I'm not saying that's the answer, I mean, people are asking, where, if you've got generic scenarios, like, we quite often have, or general, we should say, trying to capture, what's happening across all transactions, and then you've got others that are very tailored, where is the sweet spot, especially if you're dealing with, an organization that might have, different lines of business as well. Like, for example, we have, you might have corporate banking, retail banking, investment banking. So how do you actually get that holistic view, but also the specific view of what's happening and, in the risk as it translates for the different segments potentially of the bank, or as they manifestate in different regions, etc. How does this all come together? I think, Manuel, you're dealing, with, different parts of the world that you've mentioned. How does this work?
By accepting that there is not a sweet spot, but there are sweet spots for each individual region, right? I mean, we in Credit Suisse, we are operating quite a large retail bank in Switzerland, and that's actually the only presence where we do the typical retail banking. Now, Switzerland has a different kind of retail banking than probably the UK does, right? And definitely a different kind of retail banking than the US has in terms of the demographics, but also just in terms of the history of banking that we are offering. So when we are deciding in Switzerland that it makes sense to roll out a specific set of scenarios that is clearly tailored to our retail bank in Switzerland and the type of offering that we are having, while obviously, and here in that specific regard, what Muken said, a network analytics tool can make a lot of sense, right? As one of the larger Swiss franc clearance houses, right? A network analytics tool can make a lot of sense, absolutely. As one of the largest broker dealers in the US, where we are dealing primarily with DVP, RVP-based transactions, probably not so much, right? So the technology needs to obviously fit the use case underneath, and I think that's also what needs to be accepted, right? That not each of the tooling that you are building needs to be necessarily rolled out to each of your lines of business.
Mm-hmm.
I think this comes back to what are your risks, what are your issues, what is the business demand behind this, right? And there's never a one size fits all, right? Going back to the segments, there's multiples even within the single segment. So now, if we're talking retail, corporate, correspondent, et cetera, it's a complicated, never a sweet spot, multiple sweet spots, right? So
yeah, absolutely, and I think obviously the organization I work for is that kind of case where we are dealing with the different lines of business, and I think you need to really make sure you understand, again, the risk, you understand your business, but you need to overlay potentially your controls, because they could play a different role. Your specific scenario could be exactly that, a specific scenario that, you're making sure that you're covering a specific risk that is going to be, taking place, rapid movement of funds, or, all the things that we're all familiar with, probably if we're in the TM space. But when you talk about something like human trafficking, I mean, who says that human trafficking is just in your retail bank? Why are you looking on into your retail customers for that? Who says that it's not, being manifesting itself somewhere else? So things like network analytics or AI. I don't know if you guys had any experience of it. Obviously, it's very new for everyone, but that's the kind of things we need to be looking at, isn't it?
It is, but in order to do that, and I mentioned it earlier, right, we first need to do our homework, and the homework is very clearly the data. We've heard that already today a couple of times. You need to understand where your data is coming from, what your data consists of, whether the data that you're having in your transaction monitoring system is actually representing the reality of what the analysts are expecting out there. And in order then to go onto the next step, in order really to do a more holistic kind of transaction monitoring across networks, probably even across entities, et cetera, you need to harmonize your data. You need to have a harmonized data framework where a account in location A is actually equal to the definition of an account in location B. And I mean, some of you may laugh, right? But I think that's one of the problems across the industry, that given the different setups, a client is not always a client, a transaction is not always a transaction with regards to that. And as long as you don't have that standardized, it is very difficult to do to create an effective setup on the one hand, but then on the other hand also even to think about touching topics like entity resolution, etc., which is then probably the next pivotal step from a transaction monitoring point of view, to really take not just the client in itself into account, but the network of the client, probably across even entities, and alert on that network.
Yep, and it gets a feel for you guys, because when you're talking about a organization that has not only retail bank but corporate investment, etc., there's multiple feeds coming into maybe a centralized transaction monitoring system. Even if it's not centralized, it's still complicated. How do you know that this Jonathan Smith that's in the retail bank is the same as John Smith, the same as a J Smith in the investment bank? They potentially could be, but without doing that entity resolution, you won't know. And if you don't know, then there's increasing risks, and that's potentially you're missing true positives there. So yeah. Complicated subject, but definitely something that we need to be addressing.
I was wondering why we're still talking about this stuff, but that's me. I'm a bit cynical. So, but how does this impact you, that Muken, in terms of when you go in to do your implementations, right? How does it impact?
We'd need
what you're able to do for us. I think I asked that earlier on.
Yeah, I mean it's never a single
things we don't control, right?
Yeah, it's never a single thing. Oh, okay, Nice Actimize have got a lot of experience, but we're never going to be doing it alone. We're going to be sitting with the bank. We're going to be sitting with the guys who understand their business. It's their business. They know their customers. They know their products, etc. We need to work with them to understand. Okay, where how do we segment? What do we segment? How do we what thresholds? What rules even we use? Right. So, what do you normally see within your region? And it might be different between different regions, but also different parts of the lines of businesses within the bank as well. So it's never we can provide a recommendation, yeah, definitely, but it's definitely a collaborative work with the bank to actually understand what's.
You need to bring your people to the table, not just technology, right?
Exactly. It's always a human thing, yeah, definitely.
And how does this, I don't know, Manuel, from your experience, because maybe, a bigger organization, a bigger vendor has the luxury of bringing their own SMEs, etc. I think, here in particular, we talk about FinTech, red techs, they might not have that capacity. How do you, what do you say is the secret to working effectively with a big organization like Credit Suisse if you are a smaller organization you want to get in?
Well, I mean, we as Credit Suisse would first need to address very clearly our problem, what we want to solve, and then we would want to hear from a potential vendor how they can do that. And I mean, obviously, if I'm going out there to the market and say I'm interested in AI, ML, I'm getting, 100, 200, 300 different offers of generic, I mean, quote unquote, generic platforms that can do that. Clearly, every organization needs to outline what do we want to do, what are our boundaries in terms of achieving that. If I'm saying I want to reduce my false positives, let's take that as an example, right? If I'm going out there and say I want to reduce my false positives, I'm getting probably 10 different shades of gray around how to do that, from, the bad word auto closure, from, overlaying the alerts that I'm having with a multi-factor model on top of that, from a risk-based approach, right, in terms of just ranking that alert. So we as the institutions needs to say, this is the framework that we want to operate in. This is actually the platform that we want to use, but we are then very clearly expecting as well from the vendors that they come with a certain set of knowledge around what they are doing. And if a vendor is coming to us and says, look, we want to sell you a financial crime compliance application, then obviously the expectation is that that vendor knows something about financial crime and the problem they are trying to solve. I personally think it's difficult to just roll out a generic AI ML platform, and then just getting kind of okay, give me all of your data and we are telling you where the risk lies. I mean, usually banks know that better, right, than the vendors, and should know that better at the end of the day. And I think that that needs to be a starting point.
Okay. Yeah. I mean, totally agree. Again, it goes back to knowing our risk, but then, also, us from the banking side, we need to know why we're engaging a smaller vendor or somebody who doesn't have that capacity, because then otherwise, we're going to probably waste our time and waste their time as well, and they don't necessarily have that. We want the players to be in the market and, produce clever things. It benefits everyone, including the other vendors in the market. But actually, I wanted to go back a bit to the, because I did realize we talked about, that when an organization is dealing with, having more lines of business, how would you practically deal with that? Because there is there always the big question of centralized versus decentralized. Do you have a preference, either of you? And do you think, that there is, any recommendation? How would you choose to do that, and why?
I think from a technology perspective, the preference is always to centralize as much as possible, at least in terms of your data framework. As mentioned beforehand, there's not one single sweet spot, right? So you will have, if you have your data as much as possible centralized, and then feed it again out to your different detection systems that you may have, to your different rules, to your different tooling overarchingly. I think that makes a lot of sense. But clearly, you also shouldn't try to find synergies where there are no synergies, right? If you're operating a big investment bank on the one hand, and you're operating a completely different line of business in another area, then clearly common themes like entity resolution that you may find in one in a million cases, something like that, are interesting as a baseline. But it's more about actually standardizing your data and your offering from a technology perspective across the individual themes, and across the themes that you identified. If you say I have a relatively homogeneous wealth management business on a global scale, then absolutely centralization makes sense there in order to leverage synergies.
Yeah, and I don't think you need to centralize at the transaction monitoring level if you're centralizing at the data level. If you're doing it there, it doesn't matter. You can still have multiple regional transaction monitoring systems, but data that needs to be done maybe at a higher level.
Right, right. Yeah, and we know there are definitely challenges with data sharing, but also, what happens across different regions. And again, we mentioned the risk, it doesn't necessarily translate in the same way. So, just for the last couple of minutes, obviously, if anybody has any more questions, that's your last chance to throw them in. But, since we promised people we're going to tell them the secret about, effective transactional monitoring and how we're going to solve the problems, do you want to have a go at summarizing what should people be looking for and doing? Where are things going to be in 5 years' time? Are we going to be talking about the same stuff?
I think we're going to make incremental steps. I don't think we are going to see that big revolution where, we are pivoting away from all that we know today and all that we've been knowing for the last 5 to 10 years, and suddenly in a year from now, we're moving ahead. But very clearly, we see that in the industry, there is a certain trend, right, towards all of the topics that we've been talking about. And I think every organization needs to think about what makes sense technology-wise, but also from a business-wise for their specific types of businesses to implement. Do I want to leverage my AI ML-based solution for my, you mentioned it earlier, correspondent banking business because it makes sense there, while I want to stay for my retail banking more on my rule-based system for the time being? I think that's really the starting point. And then thinking that through in terms of false positives, how can I smartly manage them? I can't avoid them, right? I probably don't even want to avoid them, but if I have them, how can I group them? How can I learn from them? And how can I make sure that my analysts are not reviewing again and again the same stuff? And then finally, making sure that we are not overwhelming our transaction monitoring surveillance officers with technology they don't understand, right? If we are implementing a complex solution, then the end user ability to deal with it still needs to be available. And I mean, we had earlier actually in another panel, I think a similar question around, do we now need to only hire data scientists, right, going forward in order to deal with those alerts? And no, very clearly not, right? First and foremost, I think institutions need the best investigators because that human element cannot be neglected after all. And we need to, from a technology perspective, build tooling that is intuitive and that is not overwhelming. But we need to build tooling, right? Because analysts going into front systems and getting all of their data out of different sources, etc., across different surveillances, that is just not going to work, right? That is not going to scale.
Absolutely. Muken?
Yeah, to end up with, if we were able to provide all of that data up front, as Manuel mentioned, rather than the investigator having to go to Google, to their core banking system, et cetera, if we're able to produce that within the case management system, that already takes away a lot of that time spent from doing those boring chores that an investigator has to do, which is mind-numbing for them, and I feel for them, right? So let's try to get rid of those, which makes it more interesting, their job more interesting.
Yeah,
that's what I think.
Thank you. So I'll just summarize. I've decided to summarize by saying, basically, whatever it is you're doing, make sure you know what you're trying to do. Basically, make sure you know what your risk is and what you want the technology to be doing for you, because otherwise, you'll be chasing your tail. Thank you both.